Good morning, good afternoon, everyone. I'm Arthur from Kpler. I will be the host of this webinar. Many thanks for being with us today. You've been many to answer to our invitation, and we are very, very pleased to welcome you today. Before we start, some quick words about Kpler. Most of you already know us. We are the leading provider of solutions in commodity markets. Our core business is, of course, cargo tracking for all the commodities you see listed on the right of this slide. We also provide transparency on onshore storage with a cumulative tracked capacity of over 6 billion barrels, this being the largest coverage available in the market. In a few weeks, we will release a data-driven transparency solution dedicated to trade. This solution is currently under test, and we will keep you informed about its latest development. Last but not least, Kpler has a research and analysis department that produces reports mainly based on the huge amount of data we produce every day. This team is actually behind the preparation of this webinar, and it's now time to introduce them. The team is led by Alex Booth, based in London. Alex has more than 10 years of experience in the field of oil analytics and joined Kpler in 2018. He has worked for BP and Citigroup before working for Kpler. His team is composed of 3 senior analysts. 2 of them are based in London, and the third one is in Houston. The 2 main speakers of this webinar will be Alex Booth and Alexandre Lauer, but Homayoun and Reed will be with us to answer your questions. Just a few technical recommendations before we start the webinar. First of all, you have no stress to have regarding your camera or your microphone. They are muted, they are turned off by default in this webinar, and it will remain as such. Second important thing, you have the possibility to ask questions during this webinar. We strongly encourage it. So for this, just use the Q&A button on your Zoom window. And again, the questions will be kept anonymous. Only the panelists, only Kpler will see the questions. We'll try to answer to as many questions as possible during the 10-15 last minutes of this webinar. So it's time to start now. Thanks again for being with us. Enjoy this webinar. Ask any questions you want. And Alex Booth, the floor is yours.
Excellent, thank you, Arthur. So there's a couple of topics that we're going to be running through in this session today. The overarching theme is oil markets in the world of COVID-19, and the intention is to look at areas that we can kind of help provide real insights to what is going on that's across the oil markets, touching on storage, and also having a look at a bit of a touch on the kind of some of the gas impacts and the dry bulks impacts as well. So that's going to be the primary area, the first area that we'll look at. Then we'll be moving on towards the end of the presentation to look at what we're seeing in the kind of OPEC plus realm and how we see things proceeding over the coming weeks and through into April and onwards. So we'll start off with the impacts on demand that we've seen. And one of the kind of the key areas that we can focus on initially is what's happening with global oil inventories. So since the onset or the kind of the real ramp up of the impact of the virus in China in January of this year, we have seen oil inventories spike to just about 3.4 billion barrels. That's on a par with levels that we saw back in 2017. We have also seen oil on water reach levels of just over 1 billion barrels, and just off the highs that we saw back in 2016. And a subset of that oil on water is the floating storage piece. And we've seen increases of about 35 million barrels in floating storage against year earlier levels, and they're holding at around the kind of 100 million barrels levels. Now, just this absolute level isn't kind of the be all and end all for storage piece. What we also need to know is kind of where have we been seeing these builds, and then also kind of where can we expect further builds as well. So we hit there was a recent low point in onshore crude oil storage back in early February. So that bottomed out at about February the 8th. Now, since then, we've seen just under 110 million barrels of crude builds. Now, as you can see from the charts here, China has been the primary taker of this surplus crude so far, with builds of 45 million barrels since early February. We have seen builds in the US, although kind of nowhere near as great. Interestingly, also some quite significant builds in Saudi Arabia quite recently, and we'll be coming to those later on in the presentation. And as you can see there, we're also starting to see builds across European countries as well as the impacts of COVID-19 move from east to west, basically. And again, we'll be looking at some of those demand impacts in the rest of the world kind of as we move through the presentation. I think it's worth highlighting here, as we put in the notes, how we've actually seen a decrease in inventories over this time frame in India. Now, at 7.4 million barrels since the beginning of February, that's the single country that has done more than 5 million barrels. And the where that's interesting is they are a country that is kind of primed to take additional crude. They have a kind of a growing SPR capacity. They want to fill it. They want to be able to take advantage of this well-priced crude. Now, the difficulty in India is that they've just entered a 3-week period of very, very stringent lockdown. We've already seen reports of port restrictions or restricted activity at ports. We've already had notices of force majeure for, say, LNG cargoes, and on our other platforms, we're seeing those diversions kind of start to take place as well. So I think it's really going to be something over the coming weeks. You're not going to be seeing any change in India, but they should really be getting primed to build those inventories because they do have some capacity. And so the capacity is the next kind of really key element that we want to touch when it comes to crude oil storage. So as Artur said at the start, we have about 6.2 billion or just under 6.2 billion barrels of shell capacity that we track. Now that's across refineries, it's across storage installations, it's in SPRs, it's looking at fixed roof, predominantly floating roof, but then also certain caverns as well. Now, obviously, not all of that is usable. As I said earlier, we're tracking about 3.4 billion barrels of crude in tank. We're also tracking about 1 billion barrels of other non-crude liquids within that capacity. So that gives us around 1.7, 1.8 billion barrels of theoretical shell capacity left. Now, there are going to be many, many reasons why that capacity can't be used, kind of logistical, it's very old, it hasn't been used for years and years and so on. So what we did was we looked through every installation, and in recent history over the last 3 years or so, we looked to see what was the most amount of crude that every installation had held in tank, and we aggregated those up at a country by country basis. Now, looking at this gives us a much more kind of a metric of real usable capacity. This is tanks that we know have had this crude in them over the course of the last 3 years, and what that gives us is just over 740 million barrels of available capacity that we know has been used recently. Now, as you can see from the charts, the USA and China, and don't forget this also includes SPR capacity as well. The USA and China are there two kind of standout countries for an ability to absorb surplus crude barrels. Next, you have Japan with, where are we, 55 million barrels, South Korea at 35, and so on. So on this basis, if we think about how much kind of net length or surplus oil roughly there is in the market at the moment, here we're looking at around the 22.5 million barrel a day level. We've come to that on the basis of what's being reported by various agencies, various analyst companies around the demand impact that's up to 20 million barrels a day. And then we're also looking at the potential additional supply that we're going to have coming forward in April for that's kind of around the 3 to 4 million barrels. So if we say 22.5 million barrels a day, roughly, that 742 million barrel capacity gives us about 33 days worth of cover. So that gives us a feel for what we can do with onshore storage. There is no doubt, if it really comes to it, there is kind of going to be capacity within that 1.7, 1.8 that can be used if it's absolutely necessary. But we know that you've got just over a month to build capacity, to build storage volumes in tanks that we know have been used recently. So I'll hand you over to my colleague Alex Andlau, who's going to have a look at some of the more kind of country-specific demand impacts that we've seen.
Yes, so hello everyone. So China is of course an interesting one because it has been the first to be hit by COVID-19. So we can see here on the chart actually that the imports of crude oil from China has been up year on year. So even in March, it was up almost 1 million barrels per day compared to 2019, March 2019. That came after an increase in February of 0.1 million barrels per day compared to last year. And all in all, if we look at Q1 of this year compared to Q1 of last year, Chinese oil imports are up 0.4 million barrels per day. And it means that they absorbed a lot of barrels over the last 2 months, despite some refiners cutting their utilization. And as a consequence, we saw, as Alex mentioned earlier, inventories going up by 25 million barrels since end of February, and since early February by 45 million barrels. So if we move to the next slide on the clean petroleum products, we can see that right now in March, the exports of clean products is at the record 1.5 million barrels per day. It's a huge increase compared to a year ago. It's also an increase compared to January and February, and that is despite a large cut of utilization from refiners. So I had in mind that the teapots were at 45% at the beginning of March. Right now we are at 60%, but despite of that, they exported clean petroleum product, meaning that of course demand has been low in addition to high imports, and that's the clean petroleum product export is also increasing in Taiwan and Korea. Now, if we have a look on the LNG and coal, first one on the LNG, the chart at the bottom, we can see that for 3 months in a row, LNG imports were down. So 2 reasons, of course, less activity, manufacturing output was decreasing, but also some warm weather in the northern part of the country. And we know that 21 vessels were forced to divert at the beginning of March. LNG prices, of course, decreased, and we see right now a lot of LNG imports in Europe, which is at the all-time high, again, as it didn't arrive to Asia. On the thermal coal, it has been increasing imports on a year-on-year, but we believe that that's mainly driven by restocking rather than demand in China. Last but not least, we see right now the power generation going up by 10% mid of March compared to end of February.
So if we look at some of the other demand impacts that we've seen, and staying in Asia and looking at East Asian LPG imports, LPG this year or through this winter has already struggled through with demand issues. Now we've had pretty much across most of the Northern Hemisphere, very mild winter, which has impacted the domestic heating requirements for LPG. But we've also had a very weak, suppressed petrochemical market. Now, LPG is a very key feedstock for this market, for this sector. A lot of this has been due to the kind of the ongoing or prior US-China trade war, which was depressing global trade. Now, this worsened considerably through February as we saw the following, or the kind of the knock-on impacts in the market from COVID-19. And in fact, by the middle of February, the chart here is showing the cumulative year-to-date imports for LPG into East Asia. And we were about 700,000 tons, or just under 700,000 tons lower year on year by that point. Now, as you can see, things have actually improved, and year to date, we have now tracked year on year flat imports of LPG. Considering the growth that we saw in 2019 versus 2018, that still isn't, it's not exactly fantastic, but I think considering everything that we've seen in impacting LPG demand in the world at the moment, kind of flat growth through the first half of the year in terms of imports, and then any kind of subsequent build to the second half of the year will be deemed to be a good year for LPG. But it's just yet another of the indicators that we can use and we can see on a kind of daily basis to try and track what's happening. Now, if we move across into Europe, we can see how the demand impact from COVID-19 has, as I say, just rolled from east to west. Now, OECD Europe is a major importer of middle distillate fuels. This is looking not just at jet fuel, where clearly there has been a very, very significant impact, with most airlines reporting flights having been cut by the kind of 90% range. But it's also looking at the follow-on kind of impacts on general transportation, with Europe being a heavily diesel-dependent fuel region, and also the impact on the general industrial economy as well, with so many factories shutting down, etc. So January and February imports were already down 464 kbd year on year on average. They were also impacted by the fact that there is still quite a strong heating oil market in Europe, and again, the mild winter, as I mentioned earlier, was at play here. But then we saw a further decline through March, with imports down nearly 550,000 barrels a day year on year, and a further 135,000 barrels a day down month on month. So if we look at some of the specifics, this chart looks at Italian seaborne oil imports and also refinery utilization. So according to OPEC, refinery utilization through February dropped a multi-year low of 56%. We see no reason why this is going to return. Everything in the news at the moment, everything that's being reported, is that refineries from Germany to France to the UK are staying closed where they've been closed for maintenance, or are reducing CDU throughput and closing CDUs where they have multiple units that they can close. This reduced refinery activity falls in line with considerable declines in crude oil imports as well. And so seaborne arrivals were down 435 kbd month on month in February, and then a further decline that we're seeing, a significant decline that we're seeing into March. Now, looking, kind of tying back tying this also back into what we've been seeing on the inventory side of things, over the course of the last weekend, Italy was one of the standout countries in terms of some of our updated data reporting. I think it was about 2+ million barrel build in crude oil across the country. Now, Trieste was the largest build. This is obviously one of the main import hubs, not only for Italy, but also other inland refineries in Europe. But we also saw builds in pretty much every refinery that we were monitoring, or that we're monitoring in Italy. So that brings to an end our first section, looking at some of the demand impacts from COVID-19, what we've been seeing in the crude flows, what we've been seeing in the product flows, and what we've been seeing on the crude oil storage side. I'll hand you over to Alex now, who is going to have a run through what we can expect, what we're seeing at the moment, and what we can expect to see, some of the ramifications from the falling apart of the OPEC Plus agreement.
Yes, so that's the second part of the story on the supply side. So as you know, Saudi Arabia recently said that they will supply their customer by 12.3 million barrels per day as from beginning of April. So that's that's an equivalent of 10 million barrels per day of exports. So if we have a look on the chart, we can see that today, or so far in March, the exports were lower than in January and February, and that the highest export we had for Saudi Arabia over the last few years was at 8.2 million barrels per day. So reaching a 10 million barrels per day is not easy and can only be done by taking some oil from storage. And right now we can see that the inventories in Saudi Arabia is increasing, especially since the beginning of March. So we expect that the production can reach 12 million barrels per day, but not in the very short term. That's possible in 4 to 6 months, and rather 6 months than 4, and using also the neutral zone. So again, we expect Saudi to increase, of course, export by April, but going to 10 million barrels per day doesn't look like to be sustainable. So here we can see an increase that could be between 1 and 1.5 million barrels per day for April. So if we have a look on Russia, which is the other swing producer, of course, the spare capacity is much lower than in Saudi Arabia. It's basically 1/4 of Saudi Arabia, so 0.5 million barrels per day. On the chart here, we have the seaborne oil exports, so it's not the pipelines, but we see the seaborne oil exports as the swing in terms of production, as pipelines are usually very stable. So the story is a little bit different from Saudi Arabia, also because, as a reminder, when Saudi Arabia was cutting export by 0.4 million barrels per day in 2019, Russia was increasing actually export almost by 0.1 million barrels per day. So we see a little room for increase on Russia, also because right now the level is already at a high level compared to the history, and also compared to Saudi Arabia. Regarding the lower oil price environment, keep in mind that, of course, thanks to the weakening of the ruble by more than 17%, it supports better the economy than what we see in Saudi Arabia. The last swing producer, which has been at least in the past, the swing producers are the shale players, so the U.S. oil production. We know that the Permian Basin has been the driver of the U.S. oil export, but basically as a U.S. oil production increase over the last few years. Right now, the production is for the whole U.S. shale basin in the U.S. at 8 million barrels per day, but the legacy production change is 3.8 million barrels per day. So that means that if there is no fracking no completion for the next 12 months, the shale oil production is going down by 3.8 million barrels per day. Of course, there will be completion because there are also bigger players right now. It's not only the small players as it was the case 5 years ago. So there is all the time anyway completion. But just keep in mind that the declining production is extremely high right now. We do not expect those players to be as strong as they were in 2015. We are not in the same situation. That means that if WTI price stay below 30, we will see for sure some impacts in H2 because that means that the local price are even lower, probably by $5 to $7 a barrel. And the key reason why it's totally different today than in 2015, the last oil price collapse, is that first of all, there is no more private equity investing in the sector. The reason why is just it's impossible to do an IPO in the oil and gas sector. So it doesn't make sense to enter in the capital of a company because there is no exit strategy. That was totally different in 2015 and 16. Second point, the gearing, so the debt level is much higher than it was in 2015. And last but not least, the learning curve today is much different of what we had 5 years ago. So the potential to decrease cost is much more limited than it was the case in 2015. So basically, the U.S. shale oil production cannot survive as they did in 2015. And that's it for, the swing producers, Saudi Arabia, Russia, and the United States.
Well, thank you very much, Alexandre. We have a series of questions about floating storage. Alex Booth, can you comment on this?
Yeah, sure. So we've had, there's been a couple, one about crude, one about products. So on the crude side, the question is, we have roughly 100 or just over 100 million barrels in floating storage. How much of that is essentially available versus locked in or kind of harder to access? Ultimately, we have just under 40 million barrels of Iranian crude and 26 million barrels of Venezuelan crude within that total. So this we have about another 40 million barrels available. Ultimately, we're not exactly in an environment where this crude is called upon. If anything, I would say it's worth kind of flipping the question the other way around and saying, well, there is discussion about what's the total capacity available for floating storage? Well, currently it's about half the fleet, whereby obviously we have laden vessels, but then essentially all of the ballast vessels can come into that floating storage equation. It's just a matter of cost. And the economics against the structure. If anything, the recent actions by Aramco in terms of fixing many vessels and the huge rise in freight rates has made it very difficult with current structure to be looking at adding more floating storage vessels. So that's going to be a very interesting kind of dynamic that we see. The second element, or the second question, was around what we're seeing on products. And yes, we have seen an increase in floating storage for products. One of the issues that we have there is obviously one of the products under most pressure in the market at the moment is jet fuel. And given the quality concerns and the risks around contamination, etc., for jet fuel, it's not a product that you can hold on storage in floating storage for an extended period of time. We are seeing cargoes diverting into, say, Caribbean storage facilities. That makes more sense. I think middle distillates, so the rest of the middle distillates group, so diesel and gasol, yes, they can be stored. There is the fleet capacity to store them. It's just a question of the economics. We've certainly in the past seen, say, VLCCs of distillates, kind of diesel, gas oil being stored when there has been the structure to incentivize it. I think what it does point to in this increasing interest in floating storage for products is it's very hard on a macro level to assess using, say, the techniques that we use for crude oil, exactly how much product there is in tank. But all of this points to the move into increasing levels of floating storage points to the fact that we could be hitting limits onshore.
Okay, the next question goes to Alex on Lauer. Alex, as China kept its imports high despite low consumption, which countries managed to increase their exports to China recently?
Okay, so there is one country which was the most impressive in terms of increase of oil exports to China, which is Norway. Thanks to the Johan Sverdrup project. So Norway was basically exporting almost 0 barrels to China in 2019, and by the end of the month, by the end of the year, they start to export. And right now, Norway is exporting almost 0.3 million barrels per day to China. So that's the biggest change we had for China. There are some other players which take some benefits, which are Saudi Arabia at 0.2 million barrels per day so far this year. We have also Russia by 0.1 million barrels per day, and last Brazil. So that's the 4 players. But again, Norway is clearly the one which increased the most their export to China recently.
Thank you, Alexandre. First question goes to Alex Booth. Would China continue to import cheap oil and fill its inventories if activity doesn't pick up as fast as planned?
Yeah, I mean, my take is yes. They, as we showed earlier, they have the capacity. We see about 120 million barrels worth of capacity that we have seen used for crude oil within the last 3 years. They historically have also had a very strong appetite to purchase crude at a flat price that they think is acceptable. Unsurprisingly, I think it's there would be no one thinking that as a flat price buyer of crude, this isn't a bad time to be purchasing it. Obviously, you come across the knock-on potential constraints, say, around logistics. Actually, how do you get that into the right place? Is it going into SPR? Is it going into commercial? Do the right entities have the right kind of buying licenses and permits and volume allocations and so on to take advantage of that? And obviously that's something that would have to be worked through in order to make it happen for any very large volumes over and above the quotas that have already been applied.
Thanks, Alex. How long can Saudi Arabia hold at current oil prices? What's your opinion on this, Alexandre?
So it's actually Homain speaking here. I think I may take this one on Saudi Arabia. So if we compare the situation now, what's happening in terms of oil price and where Saudi Arabia stands, and what happened 5 years ago, and if we look at Saudi Arabia's reserves of foreign cash, at the time when the oil price went from 115 to around $30 a barrel, their reserves, their foreign reserves decreased from around $800 billion to just about $550 billion. And this was in a matter of 2.5 years. So this gives you an idea of how quick their reserves, the foreign reserves can vanish. So at current oil prices, to give you a rough idea, I think they can probably stand it for the short term, but not for longer than 1.1 year and a half, 2 years max.
Oh, thank you very much, Omayun. We have a question for Reid. Reid, can you read the question and give us your opinion on this?
Yeah, absolutely. Looks like there's a question about the willingness of the Trump administration to support U.S. shale companies. I think obviously, as has been true for several years, the Trump administration is at odds with Democrats in the House. The initial deal was Republicans wanted $3 billion to purchase some 77 million barrels to fill the SPR. This has since been axed from the stimulus agreement, the $2 trillion stimulus agreement. So now the Trump administration is apparently going to the Department of Energy and looking for funds to maybe purchase 30 million barrels instead. But of course, that's a big decline. So in essence, I think, yeah, the Trump administration wants to support oil firms, but he's gonna face a lot of opposition from Democrats in the House, especially if we see further stimulus agreements. It's hard to say whether there will be some further money allocated to purchases of domestic oil production in particular.
All right, thank you, Reid. Alex on Lauer, one question for you. Oil storage at very high level, demand low, prices low, no reason for oil producers to invest in bringing new production capacity, right?
So it's true that in a very short term, we can imagine that nobody wants new production, but of course, in the long term, the story may be different. What we see clearly, and that's from the stock exchange market, is that the market is asking oil companies to cut capex as much as possible. And you saw a lot of announcements from the big oils recently, and since that has been done, the stocks are going up. So that's really what the market is looking for. Again, it's rather something in the short term that may have an impact in the longer term, but it's also due to for the big oil companies to be able to be free cash flow neutral and still deliver dividend. So I agree in the short term, nobody wants more oil, but that can change, of course, in the medium and long term. But companies are basically slashing capex by 30% in average compared to what they announced at the beginning of the year.
All right, we are reaching now the end of this webinar. There are still many questions. Unfortunately, we cannot answer all the questions now. So we will keep we'll keep track of the questions. We will answer you directly. So you'll all have answers to your questions. I'll just ask the anonymous participants to send me their questions to my email address, and this email address can be found in the confirmation email you've received. So do not hesitate to send me your questions, and we can identify you and answer you properly. Thank you very much for your participation. Many thanks again. We hope you enjoyed this webinar. Tomorrow you'll receive a follow-up email, and in this follow-up email you will find a link to download the slides of this presentation. Thanks again. Goodbye. Have a very good day. Good afternoon. See you soon. Goodbye.